Welcome to the deep dive. Have you ever paused to think about how a single policy decision, say a new tariff in one country, can trigger this whole chain reaction across global supply chains, affecting everything from like the sticker price of your next car to where huge companies decide to build their multi-billion-dollar factories?
Yeah.
Okay, let's unpack this. Today, we're sort of tracing those invisible threads, connecting global trade dynamics, a shifting economic giant like China, and some surprising challenges for international investors right here in the U.S.
It's really fascinating, isn't it? Because these three things, Mexico's tariff moves, China's complex economic balancing act, and this recent incident at a U.S. factory, they seem disconnected, right?
Right.
But they're actually all pieces of a much larger evolving puzzle. They really reflect a significant, maybe even historic, reevaluation of global trade, supply chains, investment strategies, stuff that impacts all of us.
Exactly. So today, we're not just reporting events, we're tracing those threads, connecting a factory floor in Georgia to a debt issue in China, all the way back to a tariff decision in Mexico. Our goal is to give you those aha moments, show you the hidden choreography of the global economy, make sense of it all.
Make it clear.
Yeah, clarity and impact. Let's dive in. Okay, remember that ripple effect we just mentioned? Our first big splash starts down in Mexico. The government there is proposing some really significant changes to its import tariffs. And Mexico isn't just making a minor tweak here. It feels like they're proposing a fundamental shift, one that could redraw parts of the global trade map, especially for certain sectors. So what exactly are they doing? What's the plan?
You're right. It's definitely more than a minor adjustment. Mexico is looking at increasing import tariffs on over 1,400 products. That's a lot, starting in 2026.
1,400. Wow.
Yeah. And it's not just random stuff. It targets major categories: vehicles, auto parts, steel, textiles, plastics, electronics, even things like toys and shoes. But the key thing here, the real target, is imports from countries Mexico doesn't have a trade agreement with.
Okay, and the big headline seems to be the focus on Chinese cars, right? I heard that tariffs on those could jump massively.
That's right. Potentially from the current, maybe 15–20%, all the way up to the WTO limit, which is 50%.
50%. That's huge.
Yeah.
Is this just Mexico kind of playing catch up with the U.S.'s own, protectionist moves? Or is there something more going on for Mexico itself?
Well, it's definitely multi-layered. I mean, yes, it aligns pretty neatly with U.S. pressure, especially regarding China. But Mexico is also making a very deliberate strategic move to protect its own domestic manufacturing, especially its auto industry, which is huge for them.
Okay.
They want to shield it from, a potential flood of low-cost imports. They're openly talking about boosting their own industry, correcting trade imbalances. We're talking about roughly $52 billion worth of goods potentially affected.
$52 billion.
Yeah. And the government hopes this could protect or even create around 325,000 jobs.
So it's kind of like a national level surcharge on certain foreign goods. Like
Yeah.
if you imagine your local bakery asking the town for a little extra fee on imported bread just to help them compete.
That's a good way to put it, yeah, a surcharge. But like you said, national level. On over 1,400 products, it's really about reshaping who builds what, where, and ultimately for whom, particularly in North America.
So this isn't just simple protectionism then?
Not entirely. I mean, the aha moment here is seeing how Mexico is sort of leveraging these bigger geopolitical tensions. They're positioning themselves quite deliberately as a key hub for North American production. It forces companies, especially those wanting to sell into the U.S., to really rethink their strategies.
Okay, so what are the main implications?
Well, first, Mexican manufacturers get a boost. They become more competitive. Second, companies that used to source from, say, China might now look for suppliers in Mexico or maybe Canada, other USMCA countries. It pushes supply chain diversification.
Right, makes sense. That sounds like good news for Mexican industry, maybe jobs too. But what about the flip side? For, consumers like us or businesses that rely on those cheaper imports?
Yeah, that's the trade-off. For consumers, higher import costs will almost certainly mean higher prices on, well, a lot of things.
Okay.
And for businesses using those imported components, their manufacturing costs go up. Plus, there's always the risk of trade tensions. China, for example, might retaliate, leading to more friction.
That friendshoring hub idea for Mexico is interesting. But how directly does this connect to what the U.S. is doing? Is it just convenient alignment, or is there like a more coordinated thing happening given the U.S. stance on China?
That's the really crucial link. Mexico's tariffs, particularly on Chinese EVs, fit perfectly with the U.S. strategy.
Oh,
It helps prevent what they call tariff circumvention, basically, stopping Chinese goods from sneaking into the U.S. through Mexico using USMCA benefits after maybe just a little bit of local assembly.
got it. So it plugs a potential loophole.
Exactly. It shows Mexico cooperating with the U.S. on trade, which, might give Mexico some leverage down the road. Maybe they can ask for exemptions from future U.S. tariffs or something. It's a shared logic, really.
Yeah.
Both governments emphasizing protecting domestic jobs and industry.
Okay, I see those connections. But going back to Mexico protecting its industries, you sometimes hear the argument that too much protection can, I don't know, make companies lazy, stifle innovation long term. Is that a worry here?
That's definitely the important question, the classic debate. Short term, yes, it protects jobs, boosts local firms. But long term, yeah, there's a concern that if you're too protected, there's less pressure to innovate, become super efficient, and compete globally. It's a real balancing act.
Right, a tightrope walk.
Uh,
Okay, let's shift gears. Let's pivot to another economic giant, China. It feels like there's always a complex story there,
Yeah.
often contradictory things happening at once. We're hearing about local government debt issues, but also this boom in tech, especially AI. What's the deal with the debt first?
Yeah, the debt salvation is significant. Chinese local governments are really struggling to pay their bills, specifically to private contractors and suppliers.
How bad is it?
Well, estimates vary, but they range from maybe 1 trillion yuan up to a staggering 10 trillion yuan in unpaid bills. That's roughly 1.4 trillion US dollars at the high end.
Wow. And why is this happening now?
The main culprit is the collapse of the real estate market. For years, local governments relied heavily on selling land to developers for income. That revenue stream has basically dried up, leaving them in a serious cash crunch.
Okay, so if they can't pay their bills, is Beijing stepping in with a huge bailout?
Not directly, no. And that's the really interesting part. The central government isn't just writing checks. Instead, it's encouraging state-owned banks to lend money to these local governments so they can pay their bills.
So it's more like shuffling the debt around.
That's a really good way to think about it. It's less about solving the debt crisis and more about repackaging the risk, shifting it from the local governments directly onto the books of the state-backed banking sector. It keeps things going, it maintains trust, perhaps, but it creates this sort of hidden vulnerability in the financial system. It's a bit of a shell game, honestly.
A high-stakes shell game. Okay, that's a key insight repackaging, not solving. But like I mentioned, despite this huge debt issue, we're also hearing about a lot of investment happening, especially in high tech.
Absolutely. It's one of those contradictions. Even with these debt headwinds, Chinese companies have raised a massive amount of money this year. Something like 800 billion yuan, which is about 120 billion US dollars.
And that's up from last year.
Way up. It's a 260% increase year over year. And crucially, most of this money is flowing into high-tech sectors and auto manufacturing, particularly EVs. So it shows a clear strategic shift in where capital is going, moving away from troubled areas like real estate.
So definitely not all doom and gloom then, despite the local debt problems. Money's flowing, and isn't the central bank, the PBOC, also getting involved?
Yes, exactly. The People's Bank of China is signaling it's ready to provide more support. They're considering restarting government bond trading, maybe in the fourth quarter. The idea is to inject more long-term cash, more liquidity into the system to boost confidence and support growth, especially since market sentiment has been a bit weak. It really is a complex picture.
For sure. And are there other shifts happening alongside this? Like, where are people putting their money if not real estate?
Right. Real estate is definitely out of favor as the go-to investment. What we're seeing instead is, for instance, insurance companies moving significant funds into the stock market. About 400 billion yuan this year alone, which is like 13% of their net assets.
Wow.
And the regulator, the CSRC, is actually encouraging this, telling them to put maybe 30% of new funds into stocks. It's a clear push away from property.
And what about the AI side? Is that just hype, or is it actually making money?
It seems to be generating real revenue. UBS Global Wealth Management highlighted the strong AI monetization happening in Chinese tech firms. It's boosting things like advertising revenue. One big game portal, for example, saw ad revenue grow 20% year over year recently. Compare that to national retail sales growth, which was only around 6%.
20% growth. That's pretty impressive.
It is. It shows AI isn't just a concept. It's driving actual business, creating new growth engines. Another interesting point is valuation. Chinese AI companies seem to be trading at lower multiples, maybe 17 times earnings, compared to U.S. AI firms at around 28 times. That gap could make them look attractive.
So international investors might be interested despite the other risks.
It seems so. European and Middle Eastern investors were reportedly behind 70% of recent Chinese corporate fundraising. And maybe surprisingly, U.S. investor exposure to China is apparently at a post-COVID high right now.
That is surprising. So China's doing this balancing act of managing or repackaging this debt risk while pushing hard into AI and high tech. It really makes you wonder how this internal dynamic will shape their role globally.
Exactly. That's the big question, isn't it? How does China juggle these legacy economic problems, the property slump, the local debt, with these really exciting, fast-growing tech opportunities, especially AI? This shift in investment focus away from the old drivers towards AI could be a really major long-term trend. It could reshape their whole economy and their global influence, too.
Okay, now let's bring things closer to home. Right here in the U.S., you generally assume investing in the United States is, well, pretty straightforward, pretty safe, especially for our allies.
Mm-hmm.
But a recent event down in Georgia suggests it's maybe not always smooth sailing. Let's talk about this incident at the Hyundai-LG Energy Solution battery plant. What exactly happened there?
Right. This was back on September 4th, 2025. There was a federal enforcement raid, ICE, other agencies at the construction site for this huge battery plant in Ellabelle, Georgia.
A raid. Okay.
Yeah. And they detained about 475 people. Most of them were Korean technical staff, specialists working for subcontractors on the project.
And what was the issue? Why were they detained?
The core problem was their visas. Many of them were apparently in the U.S. on B-1 business visas or using the EASTA visa waiver program. Both are meant for short-term visits like meetings or conferences.
Right.
But they were actually performing specialized technical work, things like installing and commissioning complex manufacturing equipment. That kind of hands-on work typically requires a specific type of work visa, not just a visitor visa. So there was a clear mismatch.
Ah, okay. So basically doing work that needed a proper work permit, but they came in on what amounted to a visitor's pass. That sounds like a pretty big foul-up. What were the immediate consequences for Hyundai-LG?
Oh, absolutely. Immediate and significant. The Hyundai CEO quickly announced a 2 to 3 month delay in getting the plant started up. Construction actually stopped for a bit.
That's a major hit to their timeline.
Huge. And it didn't stop there. It caused a diplomatic issue. The South Korean government lodged a strong protest demanding changes to U.S. visa policies and better protection for their technical workers over here. There was even talk back in Korea about possibly postponing future investments in the U.S. because of this.
Wow. Okay, so to make this relatable, it's like, imagine you're building a super fancy custom kitchen. You fly in a master craftsman from Italy for a couple of weeks on a tourist visa just to install this one-of-a-kind pizza oven.
Yeah.
You think it's just a quick job.
Right.
But then immigration officials show up and say, whoa, hold on. Installing specialized equipment isn't tourism, that's work, and he needs a work visa. This Georgia incident is just that, but on a massive industrial scale, right? Highlighting this critical visa mismatch.
That's a perfect analogy. And the bigger picture, the signal this sends, is really potent, especially to our allies who are investing heavily here. It basically says, look, America might not be the completely risk-free safe haven you thought it was, even for friends.
How so? What's the specific risk here?
Well, think about it. The U.S. government offers big incentives, right, through things like the Inflation Reduction Act, the Tajives Act, trying to attract exactly this kind of high-tech manufacturing investment. But at the same time, you have ramped-up immigration enforcement that snags the very technical specialists needed to build and run these plants. For foreign investors, that looks like a major policy contradiction. It introduces uncertainty. It raises what you might call a policy risk premium, basically. It makes investing here seem riskier and potentially more costly than they anticipated.
A policy risk premium. For allies, that really lands differently, doesn't it? What does this mean for other foreign companies thinking about investing or expanding in the U.S.? Are they getting nervous?
I think they have to be paying attention. It signals increased visa and labor risks, definitely. Sending skilled technicians over, even for temporary assignments, now looks trickier, carries a higher risk of detention or delays.
So more project delays are possible, like what Hyundai-LG faced.
Exactly. Which means higher costs, maybe needing to train local workers faster than planned, which also costs money. It could also increase pressure from U.S. state or federal governments to hire more locally, which might be fine, but could also lead to concerns about technology transfer for some of these foreign firms.
Right.
And you can bet companies are now going to be double and triple checking the visa compliance of all their subcontractors. It adds a whole new layer of due diligence.
So this isn't just a one-off hiccup for one company. it could actually change how allies view the U.S. as an investment destination.
I think it could. We might see more diplomatic interventions like South Korea's when these things happen. Maybe companies start thinking harder about diversifying their investments, perhaps putting a bit more into, say, Mexico, where they can access the U.S. market via USMCA, but maybe face fewer of these specific U.S. immigration hurdles. And ultimately, incidents like this could really undermine the whole friendshoring strategy the U.S. has been pushing. It chips away at the trust that's essential for that strategy to work. Allies might start demanding clearer rules, maybe even dedicated visa quotas linked to these big investments in future talks.
Okay, wow. So let's try and pull this all together. What does this all mean for us listening? We've gone from Mexico's strategic tariff changes through China's really complex economic picture, the debt, the AI boom, and landed on these surprising investment challenges right here in the U.S. for our allies. Clearly, these aren't just separate news items.
Not at all. These deep dives, they really show just how interconnected everything is. Global trade rules, the economic health of major players like China, even domestic policies like immigration enforcement. All these things are actively shaping where companies invest, how supply chains are built, and really the future landscape of the global economy.
Right.
From, the journey of a single car part all the way to the overall stability of a nation's economy, these decisions ripple outwards and affect everyone. They touch the cost of goods, the products available to us, the jobs market, the whole economic environment we live in.
So for you listening, this isn't just abstract news. It's about understanding the forces, sometimes hidden forces, that influence the price tag on things you buy, where the products you use are actually made, and how governments are constantly trying to balance protecting their own turf with the need for global trade and cooperation. It's a tricky balance.
Absolutely. And maybe a final thought to leave you with. Considering these rapid shifts we've talked about, Mexico's assertive new trade play, China's tightrope walk between old economic burdens and new technological promise, and these unexpected hurdles for even friendly investors here in the U.S., how do you think global businesses, big and small, are going to adapt? How will they navigate a world where the rules of trade, economic stability, and even just moving skilled people around seem to be getting more complex, more unpredictable, almost by the day? Something to definitely mull over.